Hi, for those of you who don't know who I am, my name is Josh and I'm from the Good Brothers Trading Academy, and today's lesson is going to be on short selling. Now, there's an illusion out there. Everyone seems to think we can only make money when the market is rising, when it's soaring to the moon. Before we get into short selling, I need you to do me a favor. Hit the like button, subscribe, turn on the notification bell. That way, every single time we upload new videos, you'll be first to be notified. Now, everybody in my family, when I first got started trading the market, they'd all start to call me or they'd ask me, hey, the market's down today. Did you make money? Are you okay? Are you going to be able to make it through this? And I'd have to say short selling is one of my favorite ways to make money in the market. Now, I thought an easier way to go about it, I decided to take a lesson out of trading in a nutshell and post it up on YouTube for everybody to see what it's about. And this discusses short selling. And so if you have any questions, be sure to ask me in the comments below. And if you already know what short selling is, write short selling in the comments below. So here is Bob.
Short selling. Short selling is a way to profit from declining stock prices. When you buy a stock, you're betting on the stock to go up. When you're short a stock, you're betting on the stock price to go down. When you buy a stock, it's called going long. The inverse of going long is going short. This is Bob. After Bob's stock chart analysis, he predicts XYZ stock is going to go down. In order for Bob to profit from XYZ, he will short sell the stock. So how does this work? Bob fills out an order form using his brokerage order window and decides to short 100 shares of XYZ. He clicks the short button, which then sends the order to short 100 shares to Bob's brokerage. In order to do this, the brokerage needs to find 100 shares to loan Bob. The broker then looks in a few different places. This can include their stock inventory, their client portfolio, or another brokerage entirely. Bob's broker locates 100 shares in one of the client's portfolios. The broker borrows the shares from the client, then sells them on the open market for Bob. XYZ stock was trading at $10 per share. $10 times 100 shares equals $1,000. The broker then credits the $1,000 to Bob's account. Bob was right. After 2 days, the stock price drops to $6 per share. Bob is now ready to return the 100 shares he borrowed. This is known as covering his position. Bob fills out another order form to buy back 100 shares of XYZ. Bob submits the order to cover his position. The broker uses Bob's borrowed money to buy back 100 shares on the open market at the current stock price of $6 per share. The broker then returns the 100 shares to his client's portfolio. This leaves the difference of $4 per share. 4 times 100 shares leaves Bob with a profit of $400.
Thank you, Bob. Let's see. So going back, let's get this rewound, and I'll take you back to the beginning. And hopefully it makes a little bit more sense. I know it went kind of fast at the cartoon, but we'll get into it. Explain it. Bring Bob back up. And now we're going to go over just step by step. So short selling is obviously you're trying to make money when the market is coming down. We know what going long is. It's bullish candles. It's when the stock price moves up. We're getting the gist. So let's start from kind of what happens. Bob has this idea that the stock price is going to go down. We have our doji candle. Okay. So he's getting confirmation that he believes the stock price is going to continue down. So the first thing he does is he fills out an order form, just like the one I have over here, and he's going to short the market. Okay, so he shorts the market, he hits the short button, and it sends the order to the brokerage, and they are going to go ahead and they're going to locate shares for him. Okay, we don't care where they find the shares. We just care that they find the shares. And they find the shares in the client portfolio, they borrow the shares. And then what's next? What's the next thing they do? They take those shares and they sell them on the open market to buyers. So Bob is taking a loan out from his brokerage account. Once the broker sells it at the price of $10 a share, that's what the going price is. He doesn't try to get more, he doesn't try to get less. He just sells it for what the going price is. There's a buyer out there that pays $10 a share. As the stock price at $10 a share and 100 shares equals $1,000. So Bob's broker then credits the account $1,000. Once the stock price starts coming back down, it's going lower in price. And this is what's confusing for most people is they go, well, if the stock price is dropping, how do you make money? Well, remember, we borrowed and they credited us our account $1,000 at $10 a share, or $10 a share and 100 shares equals $1,000 got credited to our account. As the stock price is dropping and now it's worth $6, he's going to do what? He's going to have to give back the shares in order to make the client whole again, to make the brokerage happy. So he's going to fill out another order form and he's going to buy to cover his position. It's called covering. He's going to buy to cover his position another 100 shares because he owes somebody 100 shares. So he hits the buy button, but remember it's at $6 a share. It's not at 10 anymore. Okay? So the $1,000 that was loaned to him, the broker's going to take the $1,000 that's already in his account. He's going to buy at the going rate. The going rate now is $6 per share. So he's going to buy those shares, another 100 shares to make his client whole. There's the sellers. Okay. That leaves him a profit. There's $4 difference from $6 to $10, of $4 profit per share. There's 100 shares times 4 gives you $400. Okay. Now let's kind of break it down into even what I believe to be even simpler terms. We'll use a real life scenario. If you go to your neighbor or your brother, sister's aunt's cousin, your mom or dad, and you borrow a gallon of milk, and let's say they paid $3 for this gallon of milk, and you use all the milk and you promise that you would give them back and you would return a gallon of milk to them. So you go down to the store, but you get lucky. The milk is on sale. It's on sale at 50% off, so now it's only $1.50. You buy the exact same 2% milk and you return it to your mom. Do you owe your mom $1.50 because she spent $3 on milk? Or do you just make her whole with giving her back 1 gallon of milk? It's the same concept. We are getting the shares at a discount rate and we're buying them back at a discount rate, and the broker is perfectly okay with that because we returned the gallon of milk or the shares back to the original person. That's how we make money in the market on the short side. Okay, that's short selling in a nutshell. Okay, so I hope you enjoyed Bob, and I hope that clarified a little bit on how to make money when the stock is crashing. It can be kind of difficult to understand. You're buying a stock at $140 and it's crashing and you're still able to make money as the stock price is falling. So I hope this helped. That we created this video for others that had questions pertaining to short selling. So again, if you guys have questions, please ask questions so we can answer them. I want to help. And if you know others that need some assistance in understanding short selling, please share the video. And don't forget to like and subscribe to our channel. And I'll see you in the next video.